Just excited to introduce my guests, Michael Wayne, Managing Director of Medallion Financial, and Peter McGuire. He is CEO of XM Australia. Gentlemen, welcome to the program. Great to have you both here. Pete, Michael, let's just start with you. Down 21 points, but when you put it in perspective, I suppose not a big surprise when you see some of the pressure that came through on US markets and around the region.
Yeah, and we've had a pretty good run over the last sort of week or so. 7 or 8 trading days. I think we've had 7 or 8 up, maybe 1 or 2 down days. And we've recovered about half of the falls that we incurred throughout October, so we've had a fairly decent run of it. We saw a bit of rotation today in some of the safer yield sectors. Things like utilities got a bit of a bid, some of the real estate investment trusts, but when you haven't got the energy sector on side, materials and the banks under a bit of pressure, it's hard for the market to continue the strong momentum that it's had.
And we had the mining stocks, Peter, under pressure. Copper is having a bit of a tough time, isn't it?
Absolutely. I mean, when you look at it, the whole complex, you know, crude, copper, the whole market's been fairly well washed out over the last, say, 9 or 10 sessions, and there's probably further downside. Softness, strengthening US dollar and all of that, put it into the pie. It's going to be a very interesting rest of November lead up to Christmas.
Yeah, certainly so. I just noticed this in relation to the miners as well. Queensland is gearing up to unveil proposed resource regulations next week that will require the miners to pay into an insurance fund for the remediation of old mines. That's actually an interesting story worth following next week. Yeah. All right, let's bring in Fiona Clark. Fiona Clark is joining the conversation from Merrick's Capital, and she is live in Melbourne. Fiona, let's get back to the day that has come and gone for the most part. Quite a sort of mixed performance when you look at the sectors overall. I mean, we did mention the energy space, the materials coming under pressure, but the A-REIT space and the utilities. So what are those sort of, sectors really telling us about risk appetite and about, I guess, mitigating against risk?
Michael kind of summed it up a bit. We have had yesterday was a fairly significant day in terms of not just strong performance, but also we saw some of the high growth, high PE companies start to do really well. And then today we've seen, the market's only down, 20 points. It's not a huge pullback, but it has been dominated by gains in those more defensive sectors. So I think it's sort of suggesting that, yes, we are cautiously optimistic that the midterms being over and the FOMC being passed us suggests that the market may be recovering from the October lows, but not prepared to be too aggressive about that confidence, and so just taking it easy for the moment and being a little bit more defensive in the way the market's playing things.
Yeah, certainly so. So defensiveness. Now, we will talk about all of those themes, including the US Fed, but Fiona, Michael, Pete, just like to get our viewers across some breaking news that's coming in from Woolworths. Now, this is not entirely a surprise. We've known that Woolworths has been looking to offload its fuel business. Woolworths saying that it's entered into a binding agreement to sell its 540 Woolworths-owned fuel convenience sites to EG Group. So selling that petrol business in a deal for $1.725 billion. The transaction is subject to Foreign Investment Review Board approval. So still does have a ways to go, but that is big news coming from Woolworths after the market close. So a little bit more detail coming through as well. EG Group has entered a 15-year commercial alliance for its fuel discount redemption, loyalty, and wholesale product supply as well. Management and operations team from the Woolworths petrol business will transfer to EG Group following the completion of the sale. So, you know what's coming. I'll start with you, Fiona. I know you're not having a chance to read any of the detail, but any initial thoughts on this news coming through from Woolworths?
I'm going to take a punt and say I think it's going to be positive because it will reduce quite a lot of uncertainty. I'm not sure how that price of $1.7 billion factors in terms of expectations. So it might be that that's a little bit less or a lot less than what the market would want. So it could be negative, but I definitely think that the announcement in itself will be positive in terms of reducing that uncertainty about what was going to happen after the previous arrangement was not pursued.
Yeah, and we did actually have sort of wind of EG potentially being a bidder and close to securing a deal for those assets earlier in the week. Woolworths, UBS, Morgan Stanley, have really been trying to find a buyer for these petrol assets after that unsuccessful attempt to sell the unit to BP. So again, that ran into problems when it came to the ACCC. So what do you think the likelihood, Michael, of this deal getting over the line?
Look, it's anyone's guess, but in recent times, anything that's gone to Foreign Investment Review Board or ACCC, it's a bit of a lucky dip. So time will have to tell with this one. I think it is a positive for Woolworths in general that if they can get this transaction over the line. Obviously, it's a non-core business. The economics of these fuel-type businesses is being called more and more into question. We've seen Caltex under a bit of pressure. There are a lot of variables that go into these fuel businesses, whether it's currencies, whether it's the oil price, but also the economics or the efficiency, of many vehicles is improving. We're using less and less volumes of fuel. And so the way that they're looking to make money is getting people to move up from some of the cheaper petrols to the more premium petrols. So it's becoming more of a retailing business, but a bit more specialised. And I think that Woolworths moving on makes a lot of sense.
All right, and Woolworths shares, I mean, obviously this was before this announcement, closing the day up by 0.25%, $29.42. So I guess, the follow-on question, Fiona, would be, does offloading this petrol business for that price tag, 1.7 billion, I mean, is Woolworths, an interesting proposition for you as an investor?
Listen, I think that it doesn't, it's not unattractive, and I certainly think that with the demerger of Coles, I think that the outlook from a specific perspective of margin control is probably in Woolies' benefit. I think its most recent trading numbers were reasonable. They weren't great at a headline level, but the momentum seemed to be improving. I also think that margins will be protected. Coles will, Wesfarmers will want to set Coles up in a strong position, so that'll be positive for Woolies. But I don't foresee that the outlook for growth is all that strong. I mean, in addition to the major discount supermarket chains, Costco and Aldi come to mind, I think that the outlook for growth is probably fairly minimal, and so it's more of a defensive position in your portfolio, potentially a core holding. But I wouldn't be. We don't hold it. I'm not excited by the outlook.
Okay. Curious just to go through a few of the other corporate stories out today now that we're here. Lendlease. I haven't even checked at exactly where shares finished the day, but boy, that was a horror story for for shareholders today. I think it was a 9.5-year percentage point drop. Worst day in 9.5 years for Lendlease shares. Finishing the day off by close to 19%, $14.19. Fiona, was this just, sell now, ask questions later type scenario? What did you make of the sort of announcement coming from Lendlease?
It was quite disappointing because this is, a further deterioration from what was previously announced. So, when you're making a downgrade and you say that, this is what we're going to have, and these are the problems we're having, and coming to the market, and then, months later saying, no, it's actually worse than that, I'm going to take a $350 million hit to the bottom line. I think it shows that management's not really in control of what's going on, and the fact that they are, doing a review of the business is sort of signifies that things have been let go a little bit. So the reaction does seem a little bit strong, but I'm not sure that I'd be rushing in. I certainly think I'd be cautious, but at face value it looks like it's a fairly over move, but it's certainly, I wouldn't be rushing in to buy it, and I'm certainly very cautious. It doesn't say a lot of good things about management's oversight of this business.
And not only that, but I suppose Lendlease to a certain extent is exposed to slowing in the residential side of the business as well. A lot of this, had to do with the infrastructure and some of the things that were out of the company control as well. Weather, for example.
Yes.
Pretty strong development pipeline. I think it's worth about $71 billion. So how did you feel about Lendlease before today? How do you feel now?
Look, we weren't that keen on Lendlease before. It was more sort of just a neutral, non-plus really about the business, just given some of the exposures it has to the housing market. Lendlease in many ways is a bit of an investment company, more so than many people appreciate these days, and that they actually contribute a fair bit of their own capital to some of these projects. This engineering and services business and construction business make up about 20% of their earnings. So it's definitely material, and I think the market loses a bit of confidence, as Fiona sort of touched on, that when management come out and they give you your assurances or give the market assurances that everything's under control, only for it to deteriorate further within a couple of months after that, the market sometimes does go a little bit heavy. So it might be worth looking at once the dust settles, but I wouldn't be rushing in either at this point in time.
Okay, so that's Lendlease. I think it's the biggest percentage point drop that we saw in the market today. So we've got Morgan's downgrading Domino's. We did get a bit of a trading update coming, Fiona, in conjunction with the AGM that was held in Brisbane this week. It appears as if we've still got high hopes for performance coming through from Domino's sort of in the second half. What did you make of the update coming from the company?
Yeah, look, I think that certainly in terms of that 2.9% same store sales for the first 17 weeks was much below what the market had expected, and the pushing out of the opening of new stores was considered to be, that reweighting to the second half, with a little lack of confidence, I guess, that they will actually be able to achieve guidance, even though guidance was reiterated, and also the view that costs under pressure from the drought, despite the fact that there's a new exciting menu for summer, which I can't wait to see. Yes, I think it's just a little bit of disappointment that the numbers weren't as exciting. And a company like Domino's, even though it has had its a bit of a correction, it's sort of bounced back a bit since April, it is sort of well loved but also well shorted, and so it's a sort of become a little bit of a trading stock and moves a little bit on news. So I think that there was a bit of disappointment, but a lot of it is also just that volatility in terms of the nature of the people who are sort of buying and selling it.
Michael Wayne, buy, hold, sell Domino's Pizza.
Inclined to sell Domino's. I didn't realise there were so many variables that went into making pizza, but this year they've had issues with hot temperatures in Europe. Now they've had issues with the drought here in Australia. Same-store sales growth is under pressure still. It continues to slow, so that's a concern. Ultimately, I think with Domino's, it's about trying to replicate what they've done in Australia in Europe, because the margins in Australian business are far higher than they are in Europe. So if they can get those margins in Europe somewhere closer towards where they are in Australia, that will unlock a lot of value for the company. But there are growing headwinds and there are growing signs to suggest that that's very unlikely. So I'm probably in the sell camp.
Okay, all right, Fiona, I know that we're going to lose you, but we can't not talk about one of the big corporate stories of the week being corporate travel management. What a roller coaster ride, obviously being targeted by VGI Group and the short sellers there. Now, do you think targeted fairly or unfairly? Choice of black and white, definitely unfairly. And I think that the announcement from Corporate Travel yesterday, when it's got EY on board to look at the accusations by VGI, basically demonstrate. EY does Flight Centre, PwC, who's Corporate Travel's own accountant, does Hello World. These auditors and accountants actually understand the business more than VGI could, and I think that the view is it's a fairly unprofessional and superficial analysis. I could talk in the detail of the accusations and the rebuttal, but it is concerning on a broader level for me, in terms of the way corporate disclosures are managed. This is a really big issue for the market, that a company like VGI, I know they've disclosed they're short, but they've got inside information to the extent that they know that this is market sensitive, and they've put a position in advance, in front running. I think it's a terrible situation, and I know it's legally above the board, but I'm on my high horse here, but I think that it's something that we need to consider, because even though the accusations and the things raised in the report have fairly much been rebutted, even little things like the amount of cash on the balance sheet at the end of the reporting, VGI saying that can't possibly be right because the amount of interest earned was wrong, and that has been refuted. It does such damage from a sentiment perspective, and I think that while the numbers look to be okay, the impact on corporate travel share price now and going forward will be damaged for quite some time. Well, it's an interesting point, Michael, because if you're advising clients, the reality is that we're seeing more and more of this type of behavior, isn't it? These reports coming out really taking aim at some of these companies and seemingly coming out of left field. So how do you manage that risk?
Well, the reality is that not a lot of retail shareholders would have access to the VGI report in the first place. So it mainly he sort of gets access, or the wholesale market really gets access to that only. So it is a bigger risk. We've seen it with the likes of Blue Sky. That was probably the poster child of these short reports. In recent years, you've had Slater and Gordon, but you've also had ones that have bounced back very quickly, like CCP, Credit Corp. There was not anonymous, but a short report coming out from a company overseas that initially fell 20-25% before bouncing back. And there's a bit of an issue because if someone's got stop losses in the market or things like that, it can very quickly cascade lower. People get stopped out on what turns out to be some bogus result. So it can have an implication. I don't know how you necessarily deal with it as such, because unless the regulation changes and unless the authorities step in and say that this is front running or this is not allowed, this is what's allowed, then you just got to, I think, ignore it.
Yeah, any view on that, Peter?
Well, it comes down to compliance. And that's the greater part. You've had a Royal Commission into the banking sector, you've had compliance running across all financial institutions, and it just seems to be a great cost of business. And when you've got the opportunity, and you hear so much about front running and those sort of those issues, any example really isn't straight playing of a market. I don't know the particular situation, but if you look at futures markets or you look at any particular commodity or you know, as far as the FX market, front running just doesn't get an opportunity to participate.
All right, Fiona, sounds quite active where you are there. Have a wonderful weekend. Thank you so much for joining us this week. We'll see you early. I believe it's on a Tuesday morning is the next time we see you. Thanks, Fiona.
Thanks.
Joining us there from Merrick's Capital. All right. Peter McGuire, we got a little bit sidetracked with corporate news there. We're going to put the focus on commodities on the other side of the break. It's been quite a week when it comes to oil. We'll talk all about that next.
It's time for more of the Final Count on Your Money.
Welcome back. Let's just recap where this local market finished today. And the 200 was down now that the dust has settled by 6 points, or about 0.1%. 5,922. The All Ords at 6,011. Call it relatively flat for the All Ords. Let's get caught up on all the major commodities news, because boy, has it been a busy one. Peter McGuire from XM. I mean, oil is officially in a bear market.
You bet.
I mean, it dropped like a lead balloon.
Well, you put your mind back to what we were saying in, you know, the early parts of October, Nadine, and you could have seen that, you know, $85 to $90 range.
Like some people were calling $100 oil.
Yeah.
Come on.
Absolutely. So it had the momentum, and everyone, all the traders were long, and then all of a sudden President Trump comes out and says, "Oh, look, I think oil prices are too high." That certainly caused, I think, a correction, or the start of the market to become, you know, a downward trend. WTI has just fallen 21-22%. It's been an almighty trade for the best part of 3 weeks. Traders are rubbing their hands with glee. Hedge funds are absolutely, you know, you just don't make money like this. And traders, US dollar strength, the winds come out of the sails, and you've got a big meeting in Abu Dhabi on Sunday. Be very interesting what happens there as far as OPEC plus.
So what is this meeting about? Who's involved in this Abu Dhabi meeting on the weekend?
You've got the Russians, you've got the Saudis, and it's a lead up to the 175th meeting on the 6th of December in Vienna. So they have a meeting every couple of weeks just to, you know, get a little bit of an idea as far as
what everybody's thinking.
Well, yeah, that's the first part, and also you've got to understand that, you know, a month and a half ago you were running at that $80 range. Now you're running at $60, and you're thinking to yourself, or 60 to 70, and you know, where does the market end? Are we in a downdraft all the way through to Vienna? What's happening with US dollar? Is there further downside? Are we going to see a 55 for a WTI? Very conceivable. So it's really taken them by surprise. I think Russia's involved in the meeting as well, and the Saudis, and just how the machinations of all that will work through. I'll be in Abu Dhabi on Tuesday, and there's a large conference there on petrol and gas for about 4 days. So it'll be interesting to see the wash, what comes over the market. Does it bounce? And I'm thinking this time next week crude could be down another couple of percent.
Really? Okay. So how do Iranian sanctions, play into this whole narrative as well?
Well, put your mind to this. You've got those 8 jurisdictions, 7 countries and Taiwan, and now they're saying, well, Russia's having no issues as far as supplying that Iranian crude. The states have said, well, look, we'll piecemeal it together a little bit. it's not really a sanction like I know sanctions that, you stop producing, you're out of game. It seems to be, words to the effect of, well, we're going to see a production cut to some extent, but there's other buyers that are going to take that slack up. China, India, and the likes of Taiwan and other, the South Koreas, Japan and so on. So it's a very hard market to ascertain what impact it's going to have until you look back in time and go, well, that's what caused another $2 or $3 or $5 to come out of the headline number.
To what extent do you say that the global economy's potentially slowed a little bit and the oil price is a canary in the coal mine, or is it purely production numbers that are affecting the oil price at the moment?
We're at 100 million barrels a day, Michael, and the big term forecast is going to be many more million barrels and more demand over the next decade or so. So that number's not going away. Electricity consumption, we're addicted to power, and while we've got these new age energies and electric vehicles and all that, that's bubbling along nicely. But the big number is motorbikes, cars, trucks, asphalt roads, and our addiction to crude. Exactly, our addiction to crude and jetliners. So, the demand picture and the consumption patterns are only increasing, and you're going to see, India is just breathtaking speed. So all of these nations, whilst they might go through a little bit of a lull over a couple of months, the big numbers are that you're going to increase production probably 1.5 million to 2 million barrels a day to meet that demand side.
Looking at the US and the shale oil, is
largest producer in the world now.
And is that still ramping up in terms of the rig count? And
Baker Hughes, I think, are running about 875 or 885. So, you put your mind back a couple of years ago and you're around that 300 number, 400. So it's certainly crept up and it's doing well. Those guys are doing extremely well as well because, $40 to retrieve it out of the ground and they're getting 60 or 62. So, there's a lot of happy, from a production side, a lot of very satisfied people that have been able to use their skill sets and, flexible workforce and do very, very nicely. The farming side has taken a bit of a hit. And, crude production has been a big saviour for many, many people in that belt.
Well, now we're in the United States and we're talking about some of the drivers of economic fundamentals. I mean, we have an FOMC that looks certainly on track to hike rates in December.
Sure.
We're talking 2, 3, 4 more next year. But then you overlay oil onto, I guess, the outlook for the American economy.
Inflation.
From an inflation perspective.
If crude was sitting here, if we were here, it's $90 and you'd be saying, well, that's really having a big impact to the man on the street, the woman on the street, the purse and the wallet, spending power and so on. But at $60 or $65, it's far more spending power. So you've got more funds there. Inflation's more or less under control. You'll see that rate rise. You saw the midterms this week. It's been incredible. If you put your mind back to the last 6 weeks, this has been an almighty 6 weeks of a quarter. October was just knocked that ball out of the park as far as vol. It was incredible. Have a look at the VIX. It was up 70% one night. So you've seen those big swings. Then you saw crude get sold off. Now you're thinking, well, what's happening with the Dow? What's happening in our markets? And what's the picture as far as gold? Where is the US dollar index? And what's President Trump going to do? Powell will probably hit the button for no doubt in December. I reckon 2 rate rises next year, 1 March. Let's see what happens after that.
Okay, so given all that we've talked about, and we did mention copper coming under pressure in the earlier piece,
Sure.
I mean, where do you sort of look, I suppose, when it comes to trading some of these commodities?
Remember, you can trade short.
Yeah.
These have been fantastic. You don't need markets to go up to make a dollar. Markets have been falling, and the capacity or the momentum that they're falling at has just been exciting. So many traders are sitting there glued to screens 24 hours a day, and they're just seeing these big washouts. And so you've only got to look at that crude market, have a look at the dollar. Put your mind, currencies are wonderful because they're open 24/5, huge liquidity, and the dollar 2 years ago was at 103 to the index, then it hit 89, now it's back at 96.5. They're big swings for any currency.
What's your dollar view?
US dollar or ours?
US dollar.
US dollar, I reckon if you get a rate rise next month, and I reckon coming into Christmas, you'll be hit at 97.25, maybe even 98 by Christmas, 96.5 now. So there's every chance you're going to see that uptick.
All right, we're out of time. Peter McGuire, always great to have you in. Thanks for joining us. Peter McGuire there from XM CEO here in Australia.